Something significant has shifted in the precious metals market. If you hold gold or silver, or if you've been watching these assets from the sidelines, what's happening right now demands your attention. Not your panic, but your careful consideration. Over the past several days, gold and silver prices have experienced sharp downward movements that caught many investors off guard. The headlines are calling it a collapse, a crash, a meltdown. And while the price action has indeed been dramatic, the reality is far more nuanced than the alarm bells would suggest. I'm not here to tell you everything is fine when it isn't, nor am I here to stoke fear when clarity is what you actually need. What I am here to do is walk you through what's actually happening, why it's happening, and what it means for your financial decision-making going forward. Because here's what I've learned after years of analyzing these markets. The moments that feel most chaotic are often the moments that separate disciplined investors from reactive ones. And right now, we're in one of those moments. The truth is, most people misunderstand what price movements in gold and silver actually signal. They see red numbers and assume something has gone fundamentally wrong with the asset itself. But that's not how this works. These markets move for specific reasons, often connected to larger forces in the global financial system that have nothing to do with the underlying value of the metals themselves. Today, we're going to examine those forces carefully. We'll look at what triggered this downturn, what history tells us about similar situations, and most importantly, how thoughtful investors navigate uncertainty without abandoning their long-term strategy. If you're holding these assets right now, I know it's uncomfortable. If you've been considering them, you might be wondering if this is opportunity or warning. Both questions deserve serious answers, and that's exactly what we're going to explore together. Let's begin with what actually happened. The immediate catalyst for this price decline came from an unexpected shift in central bank policy language. Without getting lost in the technical details, what matters is this. Signals emerged suggesting that major central banks may be coordinating a faster than anticipated tightening cycle, combined with verbal intervention designed to strengthen their respective currencies. Now, why does that matter for gold and silver? Precious metals don't trade in a vacuum. They respond to real forces, interest rate expectations, currency strength, inflation trajectories, and most critically, confidence in the existing monetary system. When central banks signal tighter policy and stronger currency defense, it creates immediate pressure on assets that traditionally serve as alternatives to fiat currencies. The term red button shock captures the sudden nature of this policy pivot. Markets had priced in one trajectory, and within hours, that expectation was challenged by coordinated statements from monetary authorities. The result was rapid repricing across multiple asset classes, with gold and silver among the hardest hit in the near term. But here's where we need to separate the immediate from the structural. Yes, prices moved sharply. Yes, it felt sudden. But sudden price movements are not the same thing as fundamental deterioration. In fact, they're often symptoms of something else entirely. A recalibration of market positioning, a shift in short-term sentiment, or in this case, a tactical response to policy signals. What we're witnessing is not the collapse of the precious metals thesis. We're witnessing a specific type of market event that has happened before and will happen again. The intersection of leveraged positioning, policy surprise, and technical selling pressure. Understanding that distinction is crucial because it determines whether you respond with fear or with comprehension. Most investors approach gold and silver with the wrong mental framework. They think of these assets the way they think of stocks, something that should go up steadily if it's working and fall if it's broken. But that's not what precious metals are. Gold and silver are monetary assets with industrial components. They function as insurance, as store of value alternatives, and as hedges against specific systemic risks. Their price movements don't follow the same logic as earnings-driven equities or yield-driven bonds. When you see gold drop sharply in response to central bank hawkishness, that's not a failure of the gold thesis. That's gold doing exactly what it's supposed to do in the short term, responding to changes in the opportunity cost of holding a non-yielding asset versus currency deposits that now promise higher returns. The confusion arises because people conflate short-term price action with long-term strategic value. They're not the same thing. Think about it this way. If you own fire insurance on your home and the insurance company announces they're raising premiums temporarily, that doesn't mean fire is no longer a risk. It means the pricing mechanism for the insurance has changed based on near-term factors. The underlying reason you own the insurance remains intact. This is the fundamental misunderstanding that causes people to make poor decisions during events like this. They see price weakness and assume the reason they bought the asset no longer applies. But in most cases, especially with precious metals, the long-term rationale, monetary uncertainty, debt sustainability concerns, inflation risks, geopolitical instability, hasn't disappeared. It's simply being overshadowed by near-term technical factors. Another reason people misunderstand this, they don't appreciate how much of the precious metals market is driven by paper positioning rather than physical demand. Futures markets, options, ETFs, and leveraged vehicles create price discovery mechanisms that can move dramatically on margin calls, stop losses, and short-term speculative flows. These movements can be violent, but they don't necessarily reflect changes in fundamental supply and demand for the physical metal. When you understand that distinction, events like this become less emotionally charged and more analytically interesting. You stop asking, why is this happening to me? And start asking, what is this revealing about market structure and positioning? That shift in perspective is what separates reactive investors from disciplined ones. To understand what's really happening here, we need to zoom out and look at the larger forces at work in the global economy. Because this price movement in precious metals isn't happening in isolation, it's part of a complex interplay between debt, inflation, currency dynamics, and central bank credibility. Let's start with debt. Global debt levels, both sovereign and private, remain at historically elevated levels. Governments have spent aggressively through recent crises, expanding balance sheets and increasing deficit financing. This creates a long-term structural challenge. How do you service rising debt in an environment where interest rates are climbing? The traditional answer has been financial repression, keeping real interest rates below inflation rates so that debt erodes in real terms over time. But that strategy requires inflation to remain elevated, which creates its own political and economic problems. Central banks are caught in a difficult position. If they raise rates aggressively to combat inflation, they risk triggering debt crises, market dislocations, and economic recession. If they keep rates too accommodative, they risk losing credibility and allowing inflation to become entrenched. What we're seeing now is an attempt to navigate that narrow path, using verbal intervention and policy signaling to manage expectations without committing to a course of action that might prove unsustainable. This is where gold and silver fit into the picture. These assets historically perform well when confidence in monetary authorities is questioned, when real interest rates are negative, and when inflation is eroding purchasing power. They struggle, at least in the short term, when central banks successfully convince markets that they have inflation under control and that currency strength is being defended. Right now, we're in a phase where markets are testing whether central banks can actually deliver on their promises. Can they raise rates meaningfully without breaking something in the financial system? Can they reduce balance sheets without triggering liquidity crises? Can they maintain currency stability while managing enormous debt burdens? These are not simple questions with obvious answers, and until markets get more clarity, we're likely to see continued volatility across multiple asset classes, including precious metals. The interest rate environment deserves particular attention. When nominal rates rise but inflation remains elevated, what matters is the real rate, the nominal rate minus inflation. If real rates are still negative or barely positive, the long-term case for gold remains strong even if near-term price action is weak. Currency pressure is another critical factor. The strength of the US dollar, in particular, has an inverse relationship with gold prices. When the dollar rallies on the back of rate expectations or safe haven flows, gold typically faces headwinds because it's priced in dollars. But that relationship can reverse quickly if dollar strength proves unsustainable, or if other major currencies begin to weaken in concerning ways. What we're really watching is a slow-motion currency competition where no fiat currency can claim to be on truly solid ground. Each has its own vulnerabilities: debt, political instability, structural deficits, demographic challenges. Gold and silver exist as alternatives precisely because of these systemic concerns. If you study market history, you'll find that sharp declines in precious metals prices are not unusual, even within larger bull markets. In fact, they're a normal part of how these assets trade over longer cycles. Let's go back to the 1970s, the last major precious metals bull market. Gold rose from $35 an ounce to over $800 by 1980. But that journey was not smooth. There were multiple corrections of 20, 30, even 40% along the way. Each time, commentators declared the rally over. Each time, new buyers who had just entered the market panicked and sold. And each time, the underlying fundamentals reasserted themselves and prices resumed their climb. The pattern repeated in the 2000s. Gold began that decade around $250 per ounce and peaked near $1,900 in 2011. But within that 11-year run, there were numerous sharp corrections that shook out weak hands and tested conviction. What drives these corrections? Sometimes policy changes, like we're seeing now. Sometimes profit-taking after strong runs. Sometimes liquidation to meet margin calls in other markets. Sometimes just technical exhaustion after prices move too far too fast. But here's what history also shows. The corrections that feel most frightening in real time are often the ones that set up the next leg higher, precisely because they flush out excess speculation, reset sentiment, and create better entry points for longer-term capital. I'm not predicting that happens here. I don't traffic in predictions. But I am pointing out that if you believe the structural conditions that favor precious metals remain in place, then periods of price weakness are not necessarily threats. They're They're potentially opportunities, depending on your timeline and risk tolerance. The 2013 correction in gold is particularly instructive. After peaking in 2011, gold declined roughly 45% over the next 2 years. It felt like a collapse. Many declared the gold bull market permanently over. Yet by 2020, gold had recovered and eventually exceeded its previous highs. Those who panicked in 2013 missed the eventual recovery. Those who understood the cycle continued accumulating or simply held through the volatility. Silver's history is even more dramatic because of its smaller market size and industrial demand component. Silver can move with breathtaking violence in both directions. During corrections, it often falls harder than gold. During rallies, it often rises faster. This volatility is a feature of the asset, not a bug, and anyone holding silver needs to understand and accept that reality. What matters most is distinguishing between cyclical volatility and structural change. Cyclical volatility is normal market behavior. Prices oscillate around trends based on sentiment, positioning, and short-term factors. Structural change is when the underlying fundamentals that support an asset thesis actually deteriorate. Right now, we're experiencing cyclical volatility triggered by policy signals and technical positioning. The structural fundamentals, debt sustainability, monetary credibility, inflation risks, have not meaningfully improved. If anything, the contradictions within the global financial system have deepened. Let me share how experienced investors approach moments like this, because it's different from how most people react. First, they revisit their original thesis. Why did they allocate to gold and silver in the first place? Was it for short-term speculation or long-term portfolio insurance? Was it based on price momentum or structural concerns about the monetary system? If the original thesis was sound and the underlying conditions haven't changed, then price volatility doesn't invalidate the position. It just tests emotional discipline. Second, they assess position sizing. Were they appropriately allocated based on their risk tolerance, or were they overextended hoping for quick gains? If you're losing sleep over a decline in precious metals, you likely had too much exposure relative to your psychological capacity for volatility. Position sizing is risk management, and moments like this reveal whether you got it right. Third, they zoom out on time frame. If your investment horizon is 5 to 10 years, what happens over 5 days or 5 weeks is noise, not signal. Long-term investors care about where things are headed over multiple years, not multiple trading sessions. Short-term price action is only relevant if you're trading, and most people shouldn't be trading assets this volatile. Fourth, they look for what the market is actually telling them versus what the headlines claim. Markets move for reasons that aren't always immediately obvious. Is this a liquidity event, a positioning flush, a genuine shift in fundamentals? The answer determines how to interpret the price action. Fifth, they stay curious rather than defensive. Instead of getting emotional about losses, they ask, what can I learn from this? What does this reveal about how these markets work? How can I use this experience to become a better investor? Disciplined investors also understand that volatility creates opportunity, but only if you're prepared. Having dry powder, cash, or liquid assets you can deploy when prices are dislocated is what allows you to take advantage of fear-driven selling. If you're fully invested with no flexibility, you can't act when opportunity presents itself. Perhaps most importantly, experienced investors don't make major decisions during high volatility periods. They don't panic sell at the bottom, and they don't aggressively buy the dip, hoping for a quick reversal. They give themselves time to analyze, reflect, and make decisions from a place of clarity rather than emotion. This doesn't mean being passive. It means being intentional. It means having a framework that guides your actions rather than reacting to every headline or price swing. One of the most valuable skills in investing is the ability to sit still when everyone around you is panicking. That doesn't mean ignoring information or being complacent. It means having enough conviction in your process that short-term chaos doesn't derail your long-term strategy. If you currently hold precious metals, here's what you need to consider carefully and honestly. First, examine your emotional state. If this price decline has you feeling genuine distress, that's valuable information. It might mean you're over-allocated. It might mean you bought for the wrong reasons, chasing performance rather than building conviction. It might mean you need to reassess whether this asset class fits your personality and risk tolerance. There's no shame in realizing that an investment doesn't match your psychological makeup. Better to recognize that now than to make decisions from fear later. Second, review your time horizon. If you bought gold and silver as long-term insurance or portfolio diversification, has anything fundamentally changed about that purpose? Are the systemic risks you were hedging against suddenly resolved? If not, then short-term price volatility, however uncomfortable, doesn't change the strategic rationale. On the other hand, if you bought with the expectation of short-term gains, this is a harsh reminder that timing markets is extraordinarily difficult. Even correct long-term theses can experience painful interim periods. Third, consider whether this is an opportunity to improve your position. If your conviction in the asset class remains strong and your original thesis is intact, periods of weakness can be chances to dollar cost average or rebalance allocations at better prices. But only if you genuinely believe in the long-term case. Never average down just to justify a losing position. Fourth, think about tax implications if you're considering selling. Depending on your jurisdiction and how long you've held the position, selling into weakness might trigger unfavorable tax treatment. Sometimes, the best decision is simply to hold and allow time to work in your favor. Fifth, stay informed but not obsessed. Following minute-by-minute price movements will drive you mad and cloud your judgment. Set a schedule for reviewing your positions, weekly or monthly, and resist the urge to constantly check prices. Emotional decisions are rarely good decisions. What you absolutely should not do is make decisions based on what you see others doing on social media or in comment sections. The loudest voices during volatile periods are often the least informed. They're either panic selling and justifying it publicly, or they're pumping their bags hoping to reverse momentum. Neither provides useful guidance for your situation. Remember that your financial circumstances are unique to you. What makes sense for someone else might be completely wrong for you. This is why having a personal investment policy or framework is so valuable. It gives you something to reference when emotions run high. If you're genuinely uncertain about your holdings, consider consulting with a qualified financial advisor who can review your specific situation objectively. Not someone who sells precious metals or has a vested interest in your decision, but someone who can help you think through the implications clearly. If you don't currently own precious metals, this environment presents both opportunity and caution, and you need to understand which applies to your situation. The opportunity is obvious. If you've been interested in adding gold or silver to your portfolio but hesitated because prices seemed extended, volatility creates potential entry points. Buying during periods of fear rather than euphoria is generally a sound principle, assuming the underlying asset has merit. But here's the caution. Don't let the appearance of a discount seduce you into buying something you don't understand or that doesn't fit your strategy. Falling prices alone are not a reason to buy. You need conviction based on research, understanding, and alignment with your broader financial goals. If you decide this is the right time to start building a position, do it methodically. Don't try to catch the exact bottom. No one can do that consistently. Instead, consider spreading purchases over time, building your position gradually as you learn more about how these assets behave. Start by understanding what you're buying and why. Gold and silver serve specific purposes in a portfolio. They're not growth assets that generate cash flows or earnings. They're stores of value and hedges against monetary uncertainty. If you understand and accept those characteristics, they can play a useful role. If you're expecting them to behave like stocks or real estate, you'll be disappointed. Also recognize that precious metals can remain volatile or underperform for extended periods. This isn't an asset class for short-term trading unless you truly understand the technical dynamics and have the risk management skills to trade them. For most people, these are buy and hold allocations that you revisit occasionally but don't actively manage. Consider the form in which you might hold these assets. Physical metal, ETFs, mining shares, futures, each has different characteristics, risks, and tax treatments. Physical ownership has costs associated with storage and insurance. ETFs have management fees and counterparty considerations. Mining shares have company-specific risks that can overwhelm metal price movements. Understand what you're actually buying. Perhaps most importantly, don't let fear of missing out drive your decision. If you skip this opportunity because you need more time to understand the space, that's perfectly fine. There will be other opportunities. Markets are cyclical, and precious metals will experience both fear and euphoria many times over your investing lifetime. Better to wait and enter with conviction than to rush in during confusion and second-guess yourself at the next downturn. Let me be direct about the mistakes I see people making during volatile periods like this, because avoiding these errors is often more valuable than identifying perfect opportunities. Don't react emotionally. Fear and greed are terrible investment advisors. If you feel a strong emotional pull to either panic sell or aggressively buy, that's a signal to pause and reflect, not to act. Strong emotions indicate you're operating from your limbic system, not your analytical mind. Give yourself time to process before making consequential decisions. Don't chase headlines. Financial media makes money from attention, not from helping you make good decisions. Sensational headlines during volatile periods are designed to generate clicks, not clarity. If you're making investment decisions based on headlines, you're probably making mistakes. Don't over-leverage. Using margin, options, or other forms of leverage in volatile markets is how people turn painful losses into catastrophic ones. If you can't afford to own an asset outright with cash you can afford to lose, you shouldn't be using leverage to increase exposure. And this is especially true in precious metals, where volatility can trigger margin calls that force you to sell at the worst possible time. Don't follow online hype blindly. Social media is filled with people promoting positions they own or strategies that worked once but won't work again. The loudest voices are rarely the most informed. If someone is promising you easy money or claiming to have secret information, run in the other direction. Don't ignore your broader financial priorities. Before you invest in anything, including precious metals, make sure you have adequate emergency savings, manageable debt levels, and appropriate insurance coverage. Speculating in volatile assets while neglecting fundamental financial health is backwards. Don't confuse activity with progress. Trading constantly, checking prices obsessively, and making frequent adjustments to your portfolio feels productive, but usually just generates transaction costs and tax liabilities. Sometimes the best action is no action. Don't assume you can time the bottom or the top. Market timing looks easy in retrospect, but is extraordinarily difficult in real time. Even professionals with sophisticated models and real-time data struggle to time markets consistently. If you're building a position, focus on buying good assets at reasonable prices over time, not trying to catch exact turning points. Don't abandon risk management. Even if you're bullish on precious metals long-term, that doesn't mean you should put your entire portfolio into them. Diversification matters. Position sizing matters. Having a plan for different scenarios matters. Investing without risk management is gambling. And finally, don't stop learning. The more you understand about how markets work, how monetary systems function, and how your own psychology influences decisions, the better equipped you'll be to navigate uncertainty. Invest in your financial education as seriously as you invest your capital. So where does this leave us? Gold and silver have experienced sharp declines following unexpected policy signals from central banks. Prices have moved with violence that feels disturbing, especially if you're holding these assets. The headlines are dramatic, the commentary is intense, and the emotions are running high. But underneath the volatility, the fundamental questions that make precious metals relevant have not been resolved. Debt levels remain elevated. Inflation pressures persist. Central banks are threading an impossibly narrow needle between controlling prices and avoiding financial instability. Currency competition continues with no clear winner. Geopolitical tensions simmer. The structural challenges in the global monetary system have not disappeared. They've simply been overshadowed temporarily by short-term policy theater. Does that mean prices will immediately reverse and head higher? I have no idea, and neither does anyone else, regardless of what they claim. Markets move based on the collective actions of millions of participants, each responding to their own information, incentives, and emotions. Predicting short-term price movements is speculation, not analysis. What I can tell you is this. Investors who understand why they own an asset, who size positions appropriately for their risk tolerance, who maintain emotional discipline during volatility, and who think in years rather than days, those investors tend to do fine over time, regardless of short-term chaos. The purpose of holding gold and silver for most people is not to time perfect trades or maximize every opportunity. It's to maintain optionality and insurance in a financial system that carries meaningful tail risks. It's to diversify beyond paper assets that depend entirely on institutional credibility. It's to have something that can't be created at will by central banks or devalued by political decisions. If those reasons still resonate with you, then this period of volatility, however unpleasant, doesn't change the calculation. If those reasons never resonated and you bought for other motivations, momentum, hype, promises of quick profits, then this is a valuable, if painful, lesson about the importance of conviction and strategy. Going forward, stay informed but not obsessed. Understand the forces moving these markets without pretending to predict exactly how or when they'll resolve. Make decisions based on your circumstances, timeline, and risk tolerance, not based on what you see others doing or what talking heads are predicting. Most importantly, remember that successful investing is not about avoiding all volatility or capturing every opportunity. It's about having a sound process, maintaining discipline through uncertainty, and making more good decisions than bad ones over time. These markets will continue to move. Headlines will continue to alarm. Prices will rise and fall, sometimes dramatically. Your job is not to control any of that. Your job is to control your response to it, to stay calm when others panic, to think clearly when others are confused, and to act with purpose when others are reacting. The crisis that headlines proclaim might be real in terms of price movements, but the crisis that actually matters is the one in your own decision-making. Will you respond with discipline or emotion, with education or ignorance, with patience or panic? That's the crisis you can actually control, and that's the one that will ultimately determine your success as an investor far more than whatever gold and silver do tomorrow, next week, or next month. Stay thoughtful, stay informed, and most of all, stay disciplined. Thank you for watching.